Hi, and welcome to my third online lecture going through the ongoing global financial crisis. I have to begin by telling you that it snowed today in Helsinki on the 5th of May. So, yeah, Finnish spring is showing her best. But the thing is that we have to face the reality. We live just 800 kilometers from the Arctic Circle, so, such springs do occur. And I think the same is occurring among the financial analyst community when it comes to the current crisis. It seems that they have finally catched up with me, basically, or the others who have been saying that this crisis is far from over. And they have started to understand that this may be very deep and long crisis, as it most likely will be. The thing is now that we have been going through the U.S. banking data for a few weeks now with our small team, and to me, it looks more and more like we could be heading to a repetition of the 1930s Great Depression. The Great Depression was actually just a major global banking crisis with over 40% of U.S. banks failing between 1929 and 1934. But it has been framed in financial history as a depression because, it was a deep economic malaise. But that is what financial crises bring. When they get serious enough or bad enough, they will bring kind of unmanageable and deep, let's say, a quite heavy. They will bring economic horrors. Let's put it that way. And I do fear that we're heading towards such an era. And the failure of the the First Republic Bank, that is crucial in that retrospect, that it kind of opens a new chapter in this crisis, which may lead us even to the depression. And that's why it's rather important to understand why it happened and what it implies. And I think the one thing that has to be emphasized also here is that this is a crisis created by the authorities, not the banks or their risk managers. I explain it shortly in quite more detail what it is. So, and I have also opened it up quite a bit in earlier lectures. But we have to understand that because this crisis has been created by the regulators or by the authorities, it cannot be fixed with more regulation. We have to probably go the other way. But to understand why we're here, or why a new chapter has been opened, we need to go through the failure of the First Republic Bank. So let's dive in. It has started to become something of a Friday treat to me to go these lectures through with you, and basically presenting the path of the crisis. We do each week with our small team. Now we go through what is happening in the crisis, analyze the data, and read also other analysis, and then we write to our customers about it. And just this week, we published a list of 200 worst U.S. banks. It was submitted to subscribers or customers of GNS Economics newsletter. And within the next, as soon as we get the data for the first quarter, we will publish our analysis or the results of our analysis of 200 most trusted banks in the US. So if you are interested in those, I urge you to, you can just Google GNS Economics newsletter and you find us there. But anyway, like I said, it is, I like lecturing. That's one thing. And because people have been, distributing and viewing these lectures so much, it's really nice to talk to you about this, educate on the stuff I learned for the past 15 years almost, and also combining it with the analysis. But like I said in the intro, now we have reached something of a divisor of sort with the failure of the First Republic, because this sets in motion what I would say the deeper or the more serious phase of the crisis. You will see it shortly what I mean, and it relates to the US real estate. That is why it's in the title and also included in the lecture. So there will be, things are in motion now, let's say, and the failure of the First Republic Bank really started them. Okay, but to those who have not watched my previous lectures, it's just, my name is Thomas Malin, and my main job is that I'm the CEO of and chief economist of GNS Economics, and I also am an associate professor of economics at the University of Helsinki, but I don't work there. I just hold the title. It's a Finnish peculiarity. I have 50 years of academic and 10 years of market analysis experience, and my academic research since 2008 concentrated on economic crisis, mostly financial crisis, but we also dealt with an inflation crisis, debt crisis, and currency crisis. But if a one topic would have to be raised above all else, it's economic crisis. So I'm a crisis researcher by training. But I have previously I specialized also on economic growth, and I have some research on income inequality too. Our firm, GNS Economics, it was founded late 2011. It became public in March 2012. We have currently 5 partners with 2 economic PhDs, and we do economic forecasting. But most importantly, we are kind of the devil's advocate. So we always look where the really nasty stuff in the global economy or global financial markets, where is it hidden? And in some cases, many have kind of misread our messages that we are always doom and gloom, but we actually are not. It's just the situation in the world economy is just so damn dark. So it just looks dark. But we had our latest outlook, which was published a week ago. It was actually entitled "Into the Bounce?" ? And it's just that the Chinese stimulus has been very heavy, record-breaking, basically. Through all this year, and we're expecting that it will show in the economic indicators. However, the banking crisis that is now resurfaced again, and it's getting more severe. It will affect that, so we're heading into recession, that's for sure. But this is basically what we do. We warn our clients, our customers, what is going to come. So we basically issued our first warning of the banking crisis that will emerge on the 28th of September 2022, so past year.
And this was started by the basically because the Bank of Finland was forced to step back in the gilt markets to stop the run on on nothing funny about that actually, but the run on the British pension funds. And I've explained this in the first lecture. And then on the 31st of March this year, we wrote that we are facing an unprecedented, multifaceted crisis, which is also called a polycrisis in the media, which is the potential to engulf the world economy. And we also warned on the coming credit crunch, and that the true magnitude of the crisis will start to reveal itself through the rising number of defaults and the increasing share of non-performing loans. And we're not there yet, which worries. But the interesting thing is, this will be left to the financial historians to decide is when did the crisis start. I think it started mid-December 2019 with the implosion of the repo markets. But one can also argue that it started in late September 2022 with the failures of the British pension system, or the near failures of the British pension system and credit system. But anyway, now I think this is out of the third or the fourth phase, depending on how you calculate it. And it started quite suddenly, as there's always these banking crises and their different waves of phases. They start suddenly, and and usually they occur during just coming into the weekend. I don't know why is that, but banking problems kind of accumulate. Maybe people get more worried that will they get their money out from the bank that's looking fragile during the weekend, so they want to get the money out before the weekend, and that's why the banking problems tend to emerge in Thursday, Friday, the heaviest, and then the banking bailout or whatever comes will appear during the weekend. And with the First Republic, it went just like this. Okay, but I have received quite many questions also on the kind of the comments on the lectures of why the crisis. So I will now just recap this, but it's explained in the first lecture in more detail, but also on the second lecture. So Basel III committee, or the Basel committee setting up the Basel III rules, it published new guidelines in 2020. And the new regulations or recommendations kind of force banks to hold a high share of so-called HQLA, or high quality liquidity assets, which means basically they could be sold at any moment. Though the idea was that they could be sold at any moment without any bigger loss. Well, this of course went completely. This didn't work out at all how they thought. But this HQLA included, for example, cash, which is kind of obvious. Only inflation, deflation affected that. Central bank reserve, which are technical at least a bit immune both to inflation, deflation, not entirely, but in some sense, and government bonds. And in the US, the Federal Reserve finalized a rule to implement the capital rules set up in the Basel III in 2013. And banks were given quite a lot of leeway to apply to these rules. I think it was 2014 and 2015. Actually, smaller banks, they had to, I don't remember the exact month when it started, but when they needed to begin to apply into these rules or have their balance sheets respond to the rules. It was sometime in 2014, and then with the bigger banks, I think it was 2015. However, at the same time, the Federal Reserve enacted zero interest rate policies. Well, it was raising rates at this point, and then started to raise rates, and it had bought trillions US dollar worth of government bonds, essentially pushing their prices very high, yields very low. And these the Fed tried to roll off this from the balance sheet in 2017 to 2018, failed, and in 2019 it started buying this again. But these two things, or rules and actions, so the Basel III Accord, well, maybe we can call it accord, and the actions of the Federal Reserve made it such that US banks were essentially forced to buy government bonds when their prices were at their all-time records. This is what happened factually. You cannot deny this. Then came the corona lockdowns and policies like the stimulus checks and all, which pushed trillions US dollar worth of new deposits into the banks, while these different measures forced them to issue emergency loans to companies. But moreover, like we see shortly, this led to kind of massive boom in housing market, in real estate and in commercial real estate. I got that into more detail. But when you combine these policies with the record aggressive rate hikes enacted by the Fed since April 2022, these policies turned US regional banks fragile. This has very little to do with the risk management of banks, because their hands were tied by the Basel III, and their balance sheets were what would be the word? Subjected to a massive interest rate risk due to the policies of the Federal Reserve. Okay, some banks have kind of hedged against this better than others. But the fact remains that kind of using the standard banking tools, this risk was unhedgeable. In a sense that you need to understand the financial system and derivatives and all that in a much deeper way, so you can properly hedge against these risks, which come not from the markets, but from the authorities, especially the Federal Reserve. So, yes, you can always you can say that, okay, banks should have done that and this and that. But in this case, they were forced and fooled to make themselves fragile. I come this at the end of the lecture. I come back to this at the end of the lecture. But this is a crisis created by regulators and authorities. Period. Okay, so what happened with First Republic Bank then? And this now opens another page in the crisis. So the main thing, once again, like with Silicon Valley Bank, like with Signature Bank, is that the collapse of the First Republic Bank is again massive run on the deposits. So during and after the banking rout, which started in March, it lost over half of its deposits. It's a massive run, although it's not so brutal as what was seen with the Silicon Valley Bank, the Signature Bank, but the run nonetheless. And that's why the bank failed. A classic bank run on deposits. However, the risk profile of the bank was such that it was heavily invested in the US real estate and especially the commercial real estate market. At the end of past year, quite astonishing share of 83% of the loan book of First Republic Bank consisted on real estate loans. Commercial real estate loans were about 25% of total loans. And deposits accounted for around 90% of the liabilities of the bank, and it had about 4 billion worth of unrealized losses. I mean, yeah, no, that's the thing. Was that the correct figure? Oh, well. Anyway, it was not a massive loss because it totaled about something like 27% of its total equity. But the run or the fragility, let's say the run on the deposits and the kind of a silent run on the other liabilities, like the liabilities in the interbank market and in the stock price, was caused by the prospect of losses it would probably sustain from the collapse of the real estate market. So if we calculate a let's say a deep recession scenario on US banks, like accord with historically higher side, let's say, loan losses. There is one bank above First Republic Bank and Silicon Valley Bank which bears worse, but First Republic Bank had the highest kind of loss rate against its total equity. Meaning that in the case of a severe recession, bank would have become insolvent quite heavily, actually. And there are very many such banks in the US. I will not go through the figures here. We have made a kind of an ethical accord in GNS Economics and within our team that we have to warn our customers on the risk of US banks, of individual banks. But I will not make them public here. We don't want to be the ones who cause or let's say aggravate bank runs. So I will not go into details here. If you want details, go and subscribe our newsletter. We will provide that information there. But First Republic Bank was going to take a massive hit from the collapse of the real estate market, which is now basically on its way. And that's kind of it fell because of the bank run, but the bank run was caused by its potential losses. Basically, that's how it went. Okay, and this kind of gets interesting when you think we don't. I haven't seen the specifics. Well, let's talk about it in a short while. So how the First Republic Bank was rescued. First, the Federal Deposit Insurance Corporation, FDIC, took over the bank, and then it lured or bribed JPMorgan Chase to buy it. So JPMorgan Chase bought the deposits and substantial amount of the assets and certain liabilities from the FDIC with 10.6 billion. And the parts of the deal that worry me are that it basically bypassed laws which state that any bank holding any more than 10% of US deposits cannot acquire or buy another bank. Well, this is not the correct forming of it, but anyway, the point is that big bank shouldn't be able to buy another big bank in the US. But this is what happened. First Republic Bank was the 16th largest bank in the US based on assets. And the interesting thing is that after the IC agreed to share loan losses up to 80%. And I think this is the rub here. This is, I think the correct forming was share of loan losses up to 80% of majority of loans. And I haven't seen what loans exactly, but I'm betting they are commercial real estate loans mostly. So JP, we can read it this way. JPMorgan Chase said that no, we will not touch this loan portfolio in the way it is. We want some guarantees. And that was a deal sweeter from the FDIC. And also, JPMorgan Chase received a 50 billion loan from the FDIC, according to Reuters. So, the loan loss section is important, but I do worry most about the first one, because it directly implies that the US authorities are willing to bypass the laws prohibiting the centralization of the banking sector in the United States. I'm not an expert on US law, US banking law. I don't know how this can be done without breaking the laws would be a crime. But I think there's some backdoor through this. But I think this sets a precedent for further concentration of centralization of deposit-taking institutions in the US. And this may play an important role when the crisis truly gets going. And we will talk about it later on. But I have gone through this scenario in more detail in my own newsletter, Thomas Malinen's forecasting newsletter, if you want to check it. And I have to mention that the subscribers of Jen's economic newsletter also get my newsletter. It's included in it. Okay, so, but the point here is all this, when you go through all this and you think all what happens here, we can conclude, not from this, but the fact is that this crisis will not end here either. Well, Jamie Dimon, CEO of JPMorgan Chase, said on the weekend, and now that the crisis is now here, this phase of the crisis is over. I doubt it. Like the Pacific Western Bank is already in trouble, and the crisis may escalate once again quite rapidly, actually. And one main reason for it is this. So here we have the real estate loans of US banks range categorized by those given out by small banks and large banks. And as you can see, since around 2012, the amount of real estate loans in small banks has grown quite remarkably, while in the large banks the amount has remained more or less in line, is now more or less in line with the real estate, the amount of real estate loans they held during the global financial crisis. And this is the rise here in loans is directly related to the first, the very low interest rate policies of the Federal Reserve, and two, its policies to purchase the mortgage-backed assets or securities, so which are called MBS. So this is a housing bubble created by the Federal Reserve and made possible, or they have been the intermediaries. The small banks have been the intermediaries to this. And when we look at the US national home price, this is the S&P Case-Shiller US national home price index. This is published monthly and it runs from 1987 till this February figure is the last. So, okay, first, if you look at the kind of rapid rise on the home prices from around 2001 till 2006 when they peaked, well, it's rapid. And this is what led to the first global financial crisis. This kind of blip. Now if you look where we are, US home prices have risen. They are like, they doubled almost from their previous peak. Not, well, maybe 80% or something, but they raised very high. And if you look at the last bit here, which is which starts from the Corona lockdowns in 2020, there's a massive and rapid rise on the price. What caused this? Basically, the US buying the mortgage-backed securities or MBS. I just read a small report of, was it the, well, anyway, US Retailers Association, or anyway, on 2020. And they said that the normal housing road or the mortgage rate broke its record down 16 times in 2020. So 16 times the interest rate you pay from your housing loans dropped below its previous record, and this pushed the massive increase in the national home prices. The Federal Reserve created another housing bubble in the US. It was not the banks. Of course, they gave out the loans. Sure, they could have not given out the loans. That's always possible. But the Federal Reserve pushed rates really low and said they will keep it there. And they didn't. And now, past year, the housing prices peaked and have dropped already. And some analysts estimate they will drop heavily from that level. Now, when you think and you consider that who holds, what banks hold the most of these loans, it's the regional banks again. Basically, they have been screwed over by the Federal Reserve. One can say that in 2008 crisis, the big banks screwed themselves up. But this has been doing of the Federal Reserve. And if you think about the small banks, okay, sure, in the housing loan section, okay, there are some people probably who are looking at the prices on the national level. But these are regional banks. They usually follow the regional issues. And someone at the higher levels would have watched the national home prices in rising and said that this is not a good thing. Maybe they did at the Fed, but it didn't react. And this is a serious thing. Because if we calculate a kind of a catastrophic scenario on the real estate collapse, we would see over 3,000 banks in the US to fall in the negative equity. And that's above, it's more than during the Great Depression. But that, of course, requires something very heavy, very massive happening in the real estate market. But considering the prices we're on, It can happen. In a normal recession environment, maybe 300 banks will fall into negative equity, which is a lot too. But yeah, we have to check what the statistics tell us in when the figures of the U.S. banks or for the first quarter come up. But these are worrying numbers, I'm telling you. And to top of it all, there is the U.S. commercial real estate sector, which is it divides analysts, it seems. We naturally don't have our own commercial real estate department in Jonas Economics, but what I read. The first thing is that vacancy rates in warehouse and industrial base are low nationally, and the national retail vacancy rate is only 5.8. It's kind of a historic low. And hotels are currently grinding record revenues per room as occupancy rates and prices have surged after COVID lockdowns ended. This is basically from the, I think this analysis of the Moody's or Morgan. Well, anyway. But like we saw, the sector is heading into a serious downturn due to the rate hikes. Well, of course, when you cannot afford a loan, then the prices start to drop. That's how the rates affect on the housing market. But analysts at Morgan Stanley forecast a peak to through in commercial real estate price decline as much as 40%. This is worse than in the first global financial crisis, or the GFC 1.0. Moreover, half of the 2.9 trillion of commercial real estate loans need to be renegotiated within the next 24 months, with lending rates up probably by 300 to 450 basis points. And most likely, a vast majority of these will be renegotiated under recessionary conditions. Yeah, there might be heavy losses there. And And the thing is that as regional banks hold most of this, they are even likely to suffer really horrible losses from the commercial real estate. Yeah. Okay, to conclude this a bit short lecture. So the Federal Reserve created a never-seen bubble in both US Treasuries and the US real estate. The bursting of the first bubble, the US Treasuries, caused the massive losses to banks from government bonds. The banking regulation basically forced them to acquire at record prices and hold till maturity. But when banks start to lose deposits, you have to get the money somewhere, and then you have to sell these with a loss. And this is this is what started the first waves of the bank runs in the US with the Silicon Valley Bank. However, the collapse of the First Republic Bank can be seen as the casualty of the ensuing bursting of the latter bubble, that is the US real estate, because of the heavy loan losses projected to the First Republic from its heavy lending on the real estate markets. So that is something that's probably ignited the run. And loan losses in the coming recession can push hundreds, if not thousands, US banks into insolvency. And this is a truly horrifying picture we are drawing here. When we got the first results from our scenarios, with the loan losses, I stared at the Excel for quite a while, because the sheer amount of banks with negative equity. So like I said, we might be heading into a repetition of the Great Depression in the US. And this is very important to remember now. All the waves of the global financial crisis 2.0 have been created by the authorities. Inflation shooting up, which is also created by the politicians and authorities, and the aggressive rate hikes that followed were the triggers for the crisis to erupt. This banking crisis was created by the authorities, and it cannot be fixed with more regulation, because the regulation is the problem. If I'm rather certain that if we would have had normal functioning economy without the Federal Reserve, without the International Basel Committee of the Bank of International Settlements setting up these rules for banks, we would not be here. If we would let bank managers to manage their own risk without the Federal Reserve and the global regulators, I'm sure we would not be here. Everything that comes after this is caused by the authorities. That's the single most important thing you have to understand from this crisis. We cannot trust the authorities to fix this because they have created it. Like after the 2008 crisis, a lot of people ask me why didn't any bankers go to court and jail? I said, I don't know. Probably because the politicization of the financial sector. After this crisis is done, we should drag the leaders of the Federal, former, let's say, Ben Bernanke, Jerome Powell, Janet Yellen, and several U.S. Treasury, what's the name? Well, heads of Treasury into court and ask why did this happen. Also, the board of the Basel Committee, because they created it. It will be truly interesting to see will that happen. I'm not holding my breath though. Okay. Thank you for this, for watching this. Please go subscribe my or Jonas Economics newsletters. And I, once again, want to thank my friend, Dr. Peter Newberg, for his comments and propositions considering the lecture, and all the remaining errors are my own. So, yeah, and I will be, well, let's see what comes in the next lecture and when I get it out. Well, we may go deeper into the US banking data on the aggregate level maybe, and there may be other bank failures occurring before that happens. But I urge everyone, especially in the US, to prepare. Raise cash, at least month's worth, of expenses. Keep it at home, because the thing is that many don't understand this, but in the modern banking crisis, the cards or even the digital payment systems through phones are unlikely to work. So cash is the key here. Okay. Yeah, once again, thank you for watching, and we will continue this later on. Stay safe. Bye.